Hey there, it's Mike Langford. Welcome to another episode of the Augmented Advisor Podcast, brought to you by Blue Leaf. This week on the show, John Prendergast and I are joined by Scott Wetzel and Aaron Hasler from SkyView Partners. SkyView offers financing, investment banking, and deal discovery for RIAs and independent financial advisors interested in buying, selling, or expanding their business. Think of SkyView as a one-stop M&A shop for financial advisory businesses. We invited Aaron and Scott on the show to explore the current M&A landscape and provide you with a better understanding of your options should you ever be considering buying or selling a business. Before we get started, please take a moment to subscribe to the podcast on Apple Podcasts, Spotify, Google, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a topic or a guest for the show, please feel free to reach out by swinging by blueleaf.com or hit us up on the socials. Blue Leaf, John, myself, we're all very active on social media. You can find us on LinkedIn, Twitter, and elsewhere. Really easy to find. I'm at Mike Langford. You can check out at Blue Leaf and John Prendergast. Real easy to find, okay? Love to hear from you. All right, let's get to our conversation with Scott Wetzel and Aaron Hasler. Well, Aaron, John, and Scott, so great to see you gents today. We are, as we were talking about before we clicked the record button, coast to coast today. So from Boston to LA, we have got it covered. And those of us, Aaron and you and myself, north and south,
Midwest
middle
is still
of the
best.
country. That's right. We're crushing it in the middle of the country here. So great to see you, gents.
You as
Good to
well.
see you, Mike.
Thanks for having us.
All right, it's going to be awesome.
Always good to be here, Mike.
That's right. That's right. So we're going to kick things off. And we're going to have a very vibrant conversation about the M&A landscape for RIAs and independent financial advisors, because this is a topic that we hear a lot. People are curious about it. We know it's in the news a lot. Anybody who follows this industry sees that there's a lot of activity happening there. And so we're hoping to answer some questions for people. But I thought we would kick things off with, I guess, from you, Aaron and Scott, what your view of the current M&A landscape looks like, right? So how many deals are we seeing? What are the scales of the deals? What types of businesses are selling or buying and so forth? Anything you can kind of help us with the kind of, what's that? Pricing?
Yeah. Add pricing in there.
Yeah. Like just kind of get people thinking about this thing a little bit. So
Well, and Aaron and I don't always have the exact same perspective, so it's good you're getting it from both of us. But from my vantage, it appears it's still a seller's market, and that's not going to change anytime soon. However, we get more sellers coming to market today, and it might have something to do with what Mr. Biden intends on doing next year. But we've had more deal flow on the sell side than anticipated, and that we've seen historically. The volume on the credit facility side continues to just explode. So a lot more transactions seem to be poised to close and are closing.
Yeah, I would agree. We've signed 3 engagement agreements this week with new clients. We're onboarding 5 over the next 3 weeks. And I think we're going to see a wild finish of 2021. I think it's going to be very, very interesting for SkyView, both from a M&A perspective and then just from the financing side of the business as well. We're kind of bracing for impact here as our pre-approvals start clicking in by the day. And so through this year, it's going to be very interesting, but I think it's going to continue into next year too, just because I think there are going to be people that, for a variety of factors are wanting to sell, and they're just going to run out of time this year, but they're going to continue with that mission into 2022.
Mike and John, to give you kind of an idea, we were hoping to get to $1 billion in closed transactions this year over, 4, 6, 7 transactions. And we have scheduled closings for in excess of $4.5 billion this year. And we've still got people to sign and that are very close to signing an engagement agreement with on the sell side. So it certainly exceeded our expectations, which are always high.
And that's fantastic, Scott. And just to clarify for our listeners, Scott, you are talking about aggregate AUM of those deals as opposed to enterprise value, right?
Correct.
Because you'd really be killing it if that were enterprise value.
I was going to say,
we would have bought you guys. We'd own this podcast by now.
I like it. I like it.
Hassler wouldn't be wearing that cheap sweatshirt if
That's
we
right.
were
That's
talking.
right.
I mean, it'd be a lot different conversation. We'd have to do this from the beach. I mean, yeah. So
And I'll tell you what, guys, I'm really glad you're here because I love me some M&A, right? Like, these are my tchotchkes from a life of investment banking prior to Blue Leaf. But so for me, it's always a good time to buy or to sell. I'm curious, from your perspective, you know, why should advisors think about now as a good time to transact? Why is now a good time to buy?
well, I think we'll address first the sell side. If you're an advisor out there that's considering selling, and many advisors don't sell their practice and kind of just wind it down very little over the course of their remaining years of their career. But today's marketplace is a lot different than it's been historically, and it's important that advisors know what options are out there. And primarily, since the inception of bank financing, which it wasn't our idea, we just copied it from Live Oak back in. They started doing the program in 2013. That really has proliferated amongst 36 or plus or minus banks across the country. You can appreciate a liquidity event at retirement. And then what we always tell our investment banking clients is, hey, you tell us what price we need to end up at, and then define how you want your retirement glide path to go. If you want to stick around for a year, that's great. If you want to stick around in perpetuity and keep doing the things you like to do, not do the things you don't want to do, that's great. Let's monetize. We're in a market that's, I'm not going to call it frothy because PE keeps buying into this and they're not dumb, right? At much higher multiples. But let's take advantage of an accommodative M&A environment to get your enterprise value for you and your family.
And speaking of enterprise value, obviously, if you're selling, you care about price. So what kind of pricing are we seeing in the market this year?
It's been really interesting because I think, as we see private equities continue to impact the industry, but they've started to, I think penetrate what's already been at the top of the market in terms of firms north of $1 billion, and they've started to go downstream, which has really changed the more middle market, 100 to $1 billion firm. And so we're seeing, I think valuations have crept up a little bit over the last 6-8 months. But if you're still looking at in terms of Ebitda, I think they still kind of, as advertised, follow along the traditional lines. If you're in that 500 to $1 billion space, you're looking at between a 6 to 8x multiple of Ebitda. Certain instances, if you have a unique value proposition, it could go higher. But what's interesting is the lower space, the 100 to 500 million. I think in part because of technology, I think some efficiencies, in the marketplace, and I think just more experience from buyers out there. We're seeing that and creep up a little bit, and because of competitive bidding, it's falling in that 6 to 8x multiple as well, which is.
And are folks buying on an EBITDA basis, or are they thinking about revenue multiples, or what are you seeing?
We still see both. For the more sophisticated firms, obviously they're looking at a multiple on EBITDA, but still the rule of thumb that we're not going to get rid of is a multiple on revenue. And to give you an idea, for the closings we had in investment banking in the second quarter and for the third quarter, that multiple on revenue ranged between, I think, on the low side at 3.4 to the high side at 5. And that's still not in line with where some of the PE firms are pricing. Now, albeit it might be larger firms, but the valuations we're seeing from the valuation companies, I was just on with one of our larger banks this morning saying, like, hey, you need to know this is not representative of actual market valuations, and your loan to value calculations are going to be higher than is reality. But obviously we are not in the valuation business, and those methodologies that we know are slow to change over time.
Sure, of course. Now flipping that around, so why is it a good time to buy? What's working for the buy side?
Yeah, I think a couple of things. One is sellers are ready, right? And we're seeing more sellers that are engaged and ready and saying, as one said to me this morning, yeah, I'm tired. He and his wife both had COVID last spring, and it kicked their butt, and it gave them a new perspective, and their perspective was now to enjoy retirement, and at 65 they're going to pull the trigger and move on and go do other things. So I think there's a collective experience from sellers, but I think the options in the marketplace have also just gotten so much stronger. When you can get 100% financing, as a buyer and be able to leverage that up and not be so price sensitive, you can really go out and find transactions that are a fit for you, and you have some flexibility in that price to get a deal done if you want to pay up for that practice because it's strategic for you in a particular location. I like to ski. I'd love to buy a practice in Montana or Utah or Colorado. Then I'm going to go do that, right? And if I want to pay up a little bit for that because it's a lifestyle advantage for me, let's do it. And
Yep.
so I think it's a great time to be a buyer.
And John, one of the things, we put listings on at apboe.com, and we get a fair amount of hate mail. We understand from the buy side community, and we point out is that, hey, the value of all the homes in the neighborhood which you live in are going up. So the good news is your practice is worth more too, right? But then as we get to the kind of finalists of, let's say, 4 to 6 different practices as buyers, we have them work with our credit team and saying, well, this is how taking your cash flow and a cash flow from the acquiree, here's how it can make sense. Here's how you utilize bank financing, and you're in the black day one. And at loan term, you own the whole thing. And by loan term, you know, supposedly enterprise value should double with market growth alone, and that's not saying you grow organically at all. So I think everybody should be in the mindset of buying and buying at these prices, even though we're seeing an uptick in pricing.
Let's dive into that concept of everybody should be in the mindset of buying now a little bit deeper, because we kind of just cover like why is now a good time to buy, right? Because there's sellers are coming into the market, and it might be a great time to do it. And demographic point to there's going to be a lot of advisors who might be looking to exit the business sometime soon. But what are the benefits of growing your business via M&A versus just relying exclusively on organic growth? Because I can imagine there are some advisors that are, hey, listen, we're growing, we're doing good. Why would they want to consider M&A as a mechanism to get the business growing and scaling it up?
Well, if they lack patience like we do, it's a much better way to go. Bringing on, a client base at, 100, 250, 300 million at a time, versus organically. And at the end of the day, though, acquiring a practice is a lot of work. And we find that most, advisors that even express an interest in a listing we might have, when it comes down to it, and they realize like how much work it's going to take to actually get that done, back away. But you compare that to organic growth, which, hey, if anybody's got a good idea for organic growth out there, please call us anytime. We'll do a podcast about it, because it's tough to impossible. And, we've seen a few ideas out there that work are very, very nichey. It's just the reality that we're in growth today.
And to add that, I think technology has gotten better for this industry by a lot in the last 5 years, right? And then you combine with this pandemic, which has now introduced people to these virtual meeting solutions. Advisors can be a lot more efficient than they ever were. And so we're seeing that, pricing is held in this industry, which is fantastic for the buyer, meaning that the client, they're still charging on average 1% to the client, right? But yet you can meet with more clients and be more efficient, and the average number of households serviced by an advisor is going up. And so that really does allow firms to, add another 200 to 300 households effectively and efficiently, and it makes a huge impact on their revenue and their profitability.
And we're seeing a lot of advisors that are letting go more of the day-to-day meeting with client responsibility, and are really in kind of an investment banking role. And it's 50, 60, 80% of their time is centered around finding acquisition targets and executing acquisitions.
It really sounds like a bunch of the things about the environment are really encouraging for buyers. Like supply is a big deal, right? There, 5 or 10 years ago, you talk to somebody who's trying to purchase, nobody's for sale. I've got to turn over 100 rocks to find one possibility, and that the idea that there's supply is a big deal. I also really like the point, Aaron, I think you made it, about private equity and how, while they've come down market, they're not likely to buy $100 million practice. And
Right.
And if you've got differential pricing where at the top end of the market you're getting better prices, M&A can be an arbitrage opportunity. You grow into these higher valuation multiples without doing much else.
Yeah, we're seeing that. I would say that's one of the top missions for the majority of these buyers today, right? It's swallow up as many firms as we can to get to that, 10, 15x multiple. And if that's your mission, fantastic. But in the meantime, they're running really profitable firms and building an enterprise. So, maybe that sale doesn't happen. Maybe they continue to own it. But the ability to go swallow up these practices. And, I would say then the practical advantage to this all is still that firms today have a better grasp on service and technology than the previous generation. So for most of these clients, it's such an enhancement in the service they're getting. It's just a personal gratification for a buyer. Hey, they've come in and they've become the savior. They're adding, planning, they're adding these services. They're offering more support. They're offering more staff time. And so it's a rewarding experience for the buyer to be able to go in and be kind of the savior to a practice and really impact the individual lives of those clients.
So you're talking about scale benefits there, really, the benefits of scale that deliver that. And I think you're right in terms of services and, breadth of coverage of services. But we even haven't touched on margin expansion, right? So if you're talking about Ebitda multiples, not only do you get to a higher multiple, but you start to grow out of that squeeze point where you don't have a lot of operational leverage. Your margins aren't as strong, say in that $400-500 million range. You start to get over $1 billion, your margins start to expand, and you're getting a higher multiple. So it's a big opportunity.
Yeah, and we're seeing that advisors are taking that to their advantage, which is, if you're a founder of a firm and you're in acquisition mode, having that scale to be able to go and hire a chief operating officer and some of the kind of executive level talent that's interested in getting into our industry, it makes just for a more effective and really a better lifestyle for the ownership group when you can really have the scale to build out the support team that you want, to not have to spend so much time in the office, right?
And you guys are all familiar with the retention rates we see in the industry. They're high. Advisors, always come to us saying that nobody can do what I do and nobody can do it better. And that's always true. Yet we find that the practices and the clients do move, and it's, anywhere from, depending on who you're looking at, 85 to 97% of the households. We find post-transaction, it's actually about 120% of AUM. And if you think about it, it seems counterintuitive, but really it makes sense, because a selling advisor, in many cases, is late 60s, probably hasn't been as engaged with the book as an acquiree who, if you're in the business of buying practices, you're working hard, right? Goes in, has a better client experience. The client actually now has a succession plan that they can see, and then they bring in more assets. So you can say what you want on the multiple on revenue and what you're buying, but at the end of the day, you're probably getting a lot more for what you're paying for, but you don't realize that until post-acquisition.
Yeah. It's really interesting that we were just also talking about the scale of what it can do for you as an individual business owner, right? Like how it can free up your time and allow you to focus on the things that are important to you, including the stuff you do outside of work. Because I imagine a large percentage of the people who are listening to or watching this episode of the show are solo advisors, right? Or operating in a 1 or 2 advisory shop. I mean, look, the average financial advisory firm has 5 people in the shop. So these are small businesses. And so when we start to think about M&A, we talk about scaling your ability to grow a real business, making the business more resilient too, right? So in the event that you get sick, I mean, we're coming through a pandemic, or maybe we're in phase 2 of it, whatever it is. But I think that's heightened all of our awareness of like, hey, I could be out of the picture, at least temporarily, for a little while. And what would happen to the business, to my clients and so forth. And maybe I want to make sure that I scale and have that, make this a more stable business. So food for thought there if you're considering.
Well, and also I think most advisors view, selling the business as, this horrible event where you turn over the keys and you're shown the door and you're ushered away. And that's not at all what we see. It's quite the opposite. The savvy buyers they want that seller involved as much as possible for as long as possible to maintain that client base and help service that client base. So the advisor can keep doing what they enjoy doing and appreciate a liquidity event, and somebody else is going to take care of all the headaches that all of us hate with running a business, right?
And speaking of growing and headaches, SkyView's now got an investment banking arm, right? Can you talk a little bit about that and what it's doing for your ability to help advisors in this process?
Well, I'll give the overarching, and then, Aaron really runs our investment banking, but, we started off, founded the firm, Aaron and myself and another partner, it's been, I think, 4+ years ago, and we created a credit facility. We're close to about $500 million in funding to date, but we were really resolving for the last, step in the process, which you go from, listing your practice or soliciting offers for sale, the investment banking or deal structure, but we built for phase 3, and then, really kind of not by choice, we decided, well, if we want to see deal structure that's accommodative of bank financing and what we really feel like is app market for today, we ended up buying a broker deal and an investment bank to help on the sell side, but help our clients there. And then we also set up, from a listing standpoint, we recognized a lot of sellers were coming to market and having an adverse experience with the current listing boards that are in the marketplace. So we created Appo to create really a Zillow type experience that we listened to the seller community and said, what do you not like? And we removed those variables, and we kept the variables that, maintain an open and free marketplace. But then I'll let Aaron speak to, actually what we're doing at the investment bank.
Yeah, and I'll piggyback on what Scott's saying. I think, one of the things that was most surprising to us when we started SkyView was the education workload that we had. We were traveling around the country giving lectures, and you could not give advisors enough information in these hour-long sessions. We'd be stuck there for another, 45 minutes, and we're like, hey, we got a plane to catch. We got to go to the next city here. Stop asking questions. And
Aaron wants himself out to be a rock star, as you can see.
I was particularly popular, right?
There was a time there, Hasler. I think it's past. I got to tell you,
I've gotten older. This business has aged me dramatically.
Yeah, you're only 25, right?
That's right. It's been a long 4 years. So, but no, I think, one of the things that we've said is because SkyView has impacted the way you can finance these practices and the way the deal structure works, what we really wanted to do was demonstrate to the other, to the marketplace, to the sell side, that, hey, you can increase multiples. You can have these deal structures where there's aggressive financing, meaning seller can receive 75% up front. They're highly motivated to ensure that their clients are staying on board with the practice and that they're well taken care of, and that they're going to participate in this kind of merger process. And so it was really just an opportunity for us to go practice what we've been preaching and demonstrate it. And it's really been fun to kind of get back into that and get back into the weeds of identifying deal structure that fits within bank financing, getting creative with transactions, and really just ensuring that sellers have a positive experience. And by having that positive experience, every seller that has a positive experience is going to go talk to 3 or 4 or 5 other advisors, and that transparency in the marketplace and really, I think, brings more sellers to market. And so I think everything we've done since inception has been, how do we help advisors and sellers understand that there's transparency in pricing, that there's the ability to get aggressive financing and secure financing, and all of this really just helps educate the marketplace. So it's been a fun way to educate the marketplace.
We always speak to bank financing, but really it's financing, right? And really on our sell side, that if someone comes to us and has an existing PE backer or some other form of financing, we're kind of like, well, great, we don't have to worry about that piece of the equation. We know we can get to closing a lot faster. And I know that of our initial closings, at least half are not being financed by SkyView Credit. I mean, whatever the best route is for that seller to getting that liquidity event and that defined retirement glide path, that's the direction we're going, and a lot of times can help speed to close.
And it also sounds like the investment bank gives you capabilities to service these larger firms, these larger deals, in a way that sort of a business brokerage approach wouldn't. You can take a more bespoke customized approach to the auction process as and as you go forward, which is really critical to creating value, obviously.
It does, and it just became frustrating to us that, many sellers would come to us and say like, hey, I'm interested in selling, and we'd say, that's great. Come back to us when you have a purchase agreement signed with the buyer, and we can help. And we'd say, well, tell us what you're interested in. They say, well, I want a liquidity event or retirement. I don't want to do a seller note. And then also we don't hear from that seller, and then we refer them to one of many M&A shops that are out there. And then we contact them and say, well, I ended up with a deal that was with a 5-year seller note. And well, I thought that's not what you wanted. Well, it's not, but it wasn't an option. And after just being kind of frustrated with that, we said, well, when we bring in, uncover a sell side lead, we can help those people, and we can retain, I think a premium purchase price. And we have a very defined process for the advisor defining to us how they want that process to go, during the acquisition and post-acquisition in retirement, to ensure that we're building deal structure that's accommodated from not just a pricing standpoint, but what do you want to do with the rest of your career? And you want to show up, you want to come to the office 5 days a week for 8 hours? Okay, the buyer's got to agree with that. And that there's not just, a set process for how you have to be shown the door from a business you built over 30 years. We're extremely empathetic to that as owners of the business as well.
You mentioned something in a recent conversation that we had. It may even have been during prep for this podcast that it came up as well. One of the benefits of working with an investment bank like SkyView's is, you've done it before, right? Most of the time when a business, an RIA or a solo practice is going to be sold, that's the first time that that individual or that team has ever entered into something like that, right? And so there's a lot of benefits of working with, Aaron and your team there, because you've actually done this before.
Well, it's just kind of absurd to us, candidly, that, when people go to sell their homes, they rarely think of doing a for sale by owner. But financial advisors have been great wealth advisors for their entire career. And therefore, their belief is that it extends to a very complex M&A transaction. And in 95% of cases, it does not. And by utilizing an investment bank, we charge a fee, obviously, but your net proceeds are going to be dramatically higher. Your experience is going to be dramatically better, and you're going to have dramatically better results post-transaction that you would if you were just trying to hammer this out between yourself and a guy across the street.
And we spent the first 2.5 years playing M&A quarterback to these transactions that would come to us for financing. These buyer and seller would come to us, they'd have a deal structure. We needed to overhaul it. And so it's really an opportunity for us to now go back and say, okay, we gave all this free advice away for the first 2-3 years. Now we can actually monetize it a little bit, provide some advice, and make an impact on people's lives. So it's rewarding to be able to do both of those.
Well, and I can also say that we did a deep dive in our transactions for the credit facility, which are over 200 since inception, and closing price relative to valuation was pretty close. On average was right about there. Or our average closing for the investment bank relative to, we call it maybe one of the gold standard valuation firms, we're at 165% of that valuation price. And this is not intended to be an advertisement for our investment bank, but there's an advertisement that at the end of the day, we're aware of what market pricing is. And look, if you want to be competitive as a buyer and out there buying, PE is here and they are real and they are coming down market. And will they come down to 100 million? Maybe. Will they come down to 200? We can substantiate they will. And to be competitive with that marketplace, if you want to go in and pay 2 and 2.5 times recurring revenue, you're not going to win. And if you do, congratulations.
Yeah, and that brings up another, I think, critical benefit of using a third party like you all, like SkyView, which is actually getting the deal across the finish line, right? Closure,
Yeah.
certainty of closure, because it's all fine and well that an amateur at this game, which most advisors are, could get to a price nominally, sort of agree on a price. But it's everything that happens after that that actually gets a deal
Right.
across the finish line. And somebody who's done, I don't know, I think it's about 80 M&A deals in my life. and they're relatively large. This guy was like 420 million, and
It all relates to the size of the tombstone, right?
right, exactly. And this one's all fancy. It's
Scott, do you have one to hold up? You're preaching to his school.
Yeah, no, calling them a tombstone, we need to change because that just does not sound good to a seller, okay? The industry needs to recognize that whoever came up with calling those things a tombstone, I'm like, what are we gonna call these? Because we got a really cool one, we'll send you one, John. I'm like, we can't call it a tombstone, for God's sake, it sounds horrible. But yeah, to your point, it's kind of like analogous to like putting out a pamphlet to your neighbors that you'd like to sell your home and then trying to put a deal together with one of your neighbors for a contract for deed and hoping that one of them wants to buy your house if you do it yourself. And seeing a price to a neighbor that really might not want to be that aggressive and really wanting to buy it. Whereas, we built Appo as a tool for our investment bank that we can source buyers across the country, which we've learned today. Advisors want to buy practices anywhere in the country because of Zoom technology certainly helped that and others. And we can source 50 to 80 buyers within 48 hours of a listing going live. Then we take them through a 10-phase due diligence process, which a lot of advisors don't think about. They might know an advisor they know and like, but have they really looked underneath the hood to see their FINRA timeline, to see what disclosures they have out there, how they actually do business? And then are they creditworthy, or do they have a PE shop behind them to actually fund the transaction? Because they can get to the finish line and all of a sudden buyer says, okay, well, how are we going to pay for this? I'll give you $4 million, but I guess you're going to need to finance this. So we'll do an earn-out, right? No, and there's no logical reason to try to do it yourself. Your net proceeds will be higher.
A couple of things have come up here, and I wonder if we can just talk about them briefly. We talk about using Appo to maybe discover businesses that are for sale if you're a buyer. And we talk about using the investment bank as well. Declare yourself a buyer and say, hey, I'm here if you find a business that looks like the right deal. How should, if somebody's listening today and they're like, I think I want to buy another business, what should they do to start kind of getting ready to find a business to buy? Like, what are some of the steps or the preparatory things they should do to kind of set that hunting mission up correctly?
So a couple of things. One of the things is we have is on our marketplace website. So it's the Advisory Practice Board of Exchange, or apboe.com. We have some tools on there and some resources. So we always encourage people to go to that site and get what we call purchasing power verified. And essentially what we want buyers to do is go out and demonstrate to these sellers that, hey, bank financing is now a capability within the marketplace. I have bank financing, I can get bank financing, and here's what I've done. I've done some homework, which is that I've gone out and had somebody look at my P&L, my balance sheet, to identify if I have enough cash flow to afford a loan and to afford this practice. And so by doing that, you're really saying to that seller that you're serious about it. You've done the preparation, you've done the homework. And then I always really like having firms build out a profile. So we have a template that's available on Appo, but some people choose to build their own. I just had an advisor that he missed out on a practice we were selling, and so he heard me mention this, and he came back and he had one designed, and it talks about the firm leadership, their assets under management, the technology they use, the resources. It's kind of a brochure, a pamphlet on their organization, but goes a little bit deeper into what they're about as a company. And really, I think what each of these buyers needs to do is create a game plan. They need to come up with a roadmap of what tools and resources do they have, how much time per week are they going to dedicate to it. And then I always say this, which is they've just got to pick up the phone and start making phone calls and reaching out to prospective sellers. And I think that's one of the most effective things. No matter how much work we do, there's only a handful of us as M&A firms around the country. And this marketplace does need more transactions. It needs more succession plans, right? And so as a buyer, by going out and being proactive and making phone calls, those advisor to advisor peer conversations are really powerful and effective. And then come back to us and we'll help, their resources to put those deals together. But they need to also start doing the homework.
Yeah, for clarity, we don't accept any buy side engagements. So any buyer that wants to get on Apple, we need more buyers on Apple, and it's completely free to go on there and create a profile and compete for the listings. And we need that competitive environment. We're trying to always foster as many people to be on there, be active. But then to Aaron's point, that's not the only mechanism or strategy you should be utilizing. It's hand-to-hand combat. It's kind of reminiscent of how we all started in this business is pick up the phone, right? And we find advisors in that demographic are very receptive to old school telephone calls. It works. So if the advisors become frustrated with organic growth that clients are hard to find by picking up the phone, call a friend, call a neighbor, call an advisor. They actually work on the phone too, and remember the good old days, and that's how we did business, right? And it works.
Yeah. And the last piece of advice I always give every buyer is you got to listen, right? Pick up the phone, ask some questions, and listen. Listen to what that seller is having to say. Listen to their body language. Listen to what they're doing. So many buyers get in there and they just want a data dump about who their firm is. And really, at the end of the day, what you have to do is build a little trust, demonstrate, through a profile or data of who you are as an organization. But be quiet. Listen to what that seller has to say and what their objectives are, and you'd be surprised at what you learn.
Well, it's 100% true that we find at the end of the day, we don't pick the buyer. We help guide all the buyers through the diligence process, and we come up with between 6 to 12 different introduction calls, depending on how many people our client wants to speak with. But the team that prevails is always the team that really listen to what the seller is looking for and puts together an LOI that reflects that, and not, well, this is our process, here's what we offer, this is what we do, take it or leave it. That doesn't work. It's just, advisors are very gifted at listening to their clients and talking about their jelly bean collection and their grandkids. Well, it's time to flip over the hat and actually listen to another advisor and ask the advisor, well, tell me about your career, tell me how you built your book of business, and tell me what you want to do now, and see if it's a fit. Listening will get them a very, very long way.
I think it's a really good point about listening and the transferability of the skills that advisors have and use every day to build their practice and create relationships with their clients, and how they can leverage those same skills to help the M&A process along, because it's equally relationship driven.
Yep. And to Aaron's point, it seems like we get a lot on the phone with a prospective, or with one of our clients as a prospective buyer, and they want to kind of launch into their pitch about who they are. Well, that'll come later, but really the seller wants to, articulate what they want and how they want things done, and about who doesn't like talking about themselves all the time, right? God knows Hasler does. So
more than anybody.
John,
what I add, John, is that Scott mentions it. It's really advisors need to say, okay, what do I do to engage with a client, right? And they have a process. But yet when they're going and engaging with a seller, I think they do the complete opposite, right? They just talk about themselves and they just say, this is my timeline, this is my objective, this is my process, this is what I want to do. Really, M&A is just like onboarding a new client. Sit down, listen, take notes, identify what the problem is, be flexible, and come up with a solution, and work with that seller and engage with that seller in a way of, you're not going in and saying to somebody, hey, we're going to do your financial plan, and this is what you're going to put into your financial plan. It's, hey, this is your financial plan. Now, how do we incorporate everything that you need? What's important to you, right? I mean, it's super easy stuff. You got, advisors do it every day, and they can apply it in the same manner and be really, really successful.
And I find, as we're talking to, we're always talking to prospective sellers, and I'm always putting myself in their shoes and saying, like, the day I got to turn over the keys at SkyView, I don't want to think about it yet, but it's going to happen. And that's going to be a tough time for me. And that's an emotional decision. It's something you built over time. And only you know how much time and how much sacrifice you made to build that firm. Therefore, this is an exceptionally emotional transaction that if the buy side doesn't understand that, just put yourself in their shoes that someday, Al Johnson and Sons, you're not going to own it anymore. I mean, Father Time is going to win, right? And at some point, so if we really start thinking about how difficult a decision this is for the sell side, really start listening and think about how you would like someone to engage you and not treat you like a transaction, which it just drives me crazy when some of these buyers come in and treat this as a transaction. This is not a transaction. This is talking about someone's career.
And it's exactly the prospecting process that advisors do every day, right? You build relationship first before you ever ask for assets. And you have to do the same thing in this process.
Right.
Yeah, like another parallel to that is, we've talked about it on previous shows about how, like, listen, as an advisor, you pretty much have the same product and same pricing as every other advisor out there, right? Give or take within a range. You have same stocks, bonds, mutual funds, and you charge about 1% AUM type of thing. When you're going to look to buy another advisor's business, well, guess what? Everybody else is going to pay the same price, give or take, right? The deal will probably look very similar. So now what we're really talking about is you taking on somebody's legacy and continuing on the relationships that they have invested 20, 30, 40 years of their life building. Like you're going to be a steward of that for the future. And they care that you're going to be the right person to take that on, because they can go find somebody else who will pay the same price as you. So it's really, really important to think about. As we get ready to wrap it up here, it's always fun. We have our little show notes of the things we want to talk about. As you start skimming through them, like, oh, we've already covered that one. But one thing I did want to dive in just in a tiny bit in more detail before we wrap up is the M&A financing concept, because I don't think every advisor is fully familiar with this, because unless they've really explored buying or selling a business, they haven't thought much about how that would work. And we've talked about it a lot, Scott and Aaron, in the past, but what is it that is different now than it was 4 or 5 years ago, even about financing that's available for these deals? Because I think most advisors, they're familiar with what you've mentioned a couple of times during the show, the earn out, right? I'm gonna put a little bit of money down, and then I'm gonna pay the exiting advisor off over 4 or 5 years maybe, and then this business will be mine. But that's not the case anymore. So I wonder if you could talk through the financing piece a little bit.
So we have to give the entire industry owes our biggest competitor a debt of gratitude. It's Live Oak Bank. Live Oak Bank was the first bank in the country to come in and actually recognize enterprise value for a wealth management practice, which we all are like, duh, makes sense. These are great businesses, great Ebitda, great EBOC, you name it. But from a banking standpoint, it's a collateral airball. We always joke that banks love tractors and silos, and we wish that advisors would start buying tractors and silos because they love tangible assets, right? So this form of cash flow lending had not come to the advisory space until Live Oak was really the first and the most progressive to do it. And then it has substantiated the advisory community over the last 10 years that they're exceptional borrowers, that we are able to bring more banks into our ecosystem and offer bank financing that advisors now need to start thinking more about. Most advisors, when we talk to them in the application process for a loan, a lot of times like, I don't know what my credit score is. Well, if you want to be in the acquisition mode, you got to start being more concerned about your credit score. You need to be more concerned about your personal balance sheet. If you're a junior partner on a team, we recognize a lot of times you're not monetizing the benefits of the practice of the senior advisor, but you need to be saving as much as you can, because if you're late 30s, early 40s, you want to buy out the senior partner for $3.5 million, you better have more than 25 grand in your checking account. The bank's just not going to do it. And that's the reason for a lot of our declines in these internal successions, although they would work. Banks aren't willing to lend someone $2 million that hasn't been a saver. And now it's time for advisors to start thinking from early on about their own balance sheet and their ability to retain financing or go the PE route and partner with a PE firm again. But that you need to be creditworthy to pull this off in today's environment.
That is a great point, Scott, because there's an old saying in small business banking that there are no small business loans, there are only loans to small business owners, and that's true here as well. So it's an important point to keep in mind.
Well, and some will point out, and it's a compliment on one side, and it's kind of an insult on the other, that we've routinely heard from our bankers as we bring them into the ecosystem that, which always just shocked Aaron and I at the beginning when we started this off, we were getting thrown out of every bank boardroom we went into. Our slugging percentage was like 10%, right? I mean, banks.
They asked me to stay around for a while. But...
yeah, just because you've got bad hair like them. But anyways, but really at the beginning, what we kept hearing, these bankers, they really aren't inclined to really say what's great about the credit, but we were kind of hearing they kind of as we're walking out the door say, by the way, why are the valuations so low? And we kind of would look at each other like they are. And now the market has started to catch up and recognize that over the last 4 or 5 years. And PE was aware of it. They've been trying to roll up this entire industry, for a long time. But then on the downside, we routinely hear, these advisors have had a great income and great Ebitda, but we're not seeing it show up on their personal balance sheet. Why does this advisor not have more saved at this point? They're in the business of advising on wealth creation and preservation, but a lot of times aren't practicing what they preach very well. And I'm all for everybody having a great lifestyle, but if you want to be in the M&A business, you need to think about your personal balance sheet.
And the last piece I'll add to what Scott's saying is we continue to preach the message is 100% financing is available. We really want, when these acquisitions are happening, we want these advisors to go out and finance the practice with the idea that you can get creative with the deal structure. But if you're saying to the seller, hey, 100% of this purchase price is accounted for, now here are the objectives that we want to have in between, then you've really advanced the ball with that and you've built the trust with that seller. You're saying, hey, I'm taking a tremendous amount of risk here. This is what I'm going through. This is what I'm doing. I'm personally guaranteeing this loan at $3.5 million. And I'm taking that good faith to take care of your client. So now that I've earned your trust, let's identify a deal structure that works for both of us and is accretive to the client relationships. And so we continue to preach that message.
I already know people are throwing, fruits and vegetables at the stage at Aaron right now when he says 100% financing and say, oh, well, this market's overheated. It sounds like something that's going to blow up. Well, remember, it's 100% financing on an asset that's extremely undervalued right now. So the bank doesn't mind going to 100% financing. And trust me, they wouldn't. They have every, incentive to say no, but because there's so much cash flow available from these practices, average Ebitda is running at 48%, that valuations are low. So currently at these levels, we can still get to 100% bank financing, get that seller cashed out for 100% of purchase price with some obviously escrow proceeds to make sure that we can hit some client retention goals, and everybody's happy.
And for those debt hawks who are thinking about that 100% leverage, bear in mind when we're talking about many of these deals are combinations of practices. It's 100% of what you're acquiring, not the entire business, right? So
that's right.
Your leverage across the entire business looks a lot more sensible.
Thank you, John, because the bank is concerned with NewCo, right? So they're taking the collateral from both and the cash flow from both to look at debt service coverage, and that's just a fancy way of saying, is there enough cash kicking off this thing to pay all the bills and to pay us back? And then LTV, or loan to value considerations. And in NewCo, you put the two of these practices together, they're cash rich and undervalued. The math works. I mean, it does. So thank you.
Fantastic. Well, gentlemen, this has been an amazing conversation. I know we're going to get a ton of questions because, again, this is a very exciting topic and people are really interested in it. And we've had lots of inbound questions about this already. So I'm assuming people are going to want to follow up with you. What is the best way, Aaron and Scott, for advisors or RIA firm teams to follow up with you guys at SkyView?
Let me give you Aaron's personal cell phone number. But if I did, he seriously would love it. He loves me on the phone all day, and that's a problem. He gives away free advice all day. No, just call our offices, and it depends on really what you're interested in. If you're on the buy side and you want to get plugged into our ecosystem of starting to buy practices, reach out to us at the Advisory Practice Board of Exchange. We have buy-side representatives that actually help you set up your account, get you ready to go. If you're looking for financing, again, it's reaching out to SkyView. You'll be assigned a relationship manager and come into your ecosystem, either as a buyer or seller. And if you're on the sell side and you want to talk about the different options that we're seeing in the market for selling your practice, that's just coming in and giving our investment bank a call. I think all the phone numbers should be available on our website at skyview.com.
Yep, skyview.com.
Perfect. Well, Aaron Hasler, Scott Wetzel, and of course, John Prendergast. It's been fantastic having you guys together today. Have a good day. Thank you.
Yep. Appreciate your time.
Thanks so much, guys.
Appreciate it.
Thanks, Mike.
Thanks, gents. Thank you very much for listening to and or watching this episode of the Augmented Advisor podcast. It was fantastic to have you with us. I hope you enjoyed this conversation and found it not only really interesting, but also maybe a little bit motivating, right? There's a lot of growth available to you if you're interested in pursuing it. And hopefully we gave you a bit of a roadmap here for getting the ball rolling. Huge thanks to Scott Wetzel and Aaron Hasler from SkyView Partners for joining us as well. What I really appreciate about them is their consultative approach to the M&A and financing process. They focus exclusively on our space, as you've heard, so you know they have worked with advisors and firms like yours before. That is a really great feeling, right? You're not just kind of being thrown to the wolves. You actually have some really experienced guides who know your business. As I mentioned at the top of the show, please do make sure you subscribe to the podcast on your favorite podcast platform, and do us a favor. Make sure you give the Blue Leaf page on LinkedIn a follow. We share every one of these episodes on LinkedIn. Very active there. We want to hear from you, so please do follow and join the community, right? That's what we're all about here, helping you grow your business and serve your clients better, right? And so by bringing you podcasts and videos like this, hopefully that helps. All right. That's all I got for you today. Hope you're staying safe and be nice to each other. We'll see you next week on the Augmented Advisor podcast. See ya.